You put away a portion of your paycheck, you stick to a sensible budget, and you never miss a credit card payment. You are executing the traditional financial playbook perfectly. Yet, at the end of the year, your actual purchasing power, the amount of housing, food, and energy your money can buy, is shrinking. You are doing everything exactly as instructed, and you are falling behind. The specific incentives for holding cash versus owning assets have shifted significantly since our parents' generation entered the workforce. Many of the familiar pieces of dinner table wisdom passed down to the middle class now function as active liabilities. These are the toxic money myths. When the rules of the game change, but your strategy stays the same, behaviors once considered safe can become the very points where your financial progress stalls. Let's examine the first myth. Save every penny. This rule trains you to focus on hoarding fiat currency, paper money, inside a standard bank account. This chart compares a typical savings account against inflation over a 5-year period. Your deposits sit on the bottom line, earning a fraction of a percent in interest, while the real cost of living climbs at 4 to 5% on the top line. That gap in the middle represents the loss of what your money can actually buy. Banks utilize this gap, taking your depreciating deposits and funneling them directly into high-yield assets for themselves, capturing the growth your cash loses to inflation. The first anti-system rule is to invest in cash-flowing assets. This means moving away from just holding currency and toward owning things that pay you to hold them, like dividend stocks or private equity. By shifting from a saver to an investor, you stop providing the banking system with the cheap liquidity it uses to grow its own wealth at your expense. The second myth is the idea that you should buy a reliable new car. While framed as a responsible choice, it is often the primary way young workers are introduced to long-term consumer debt. This gauge tracks the math. On the left, the vehicle's value drops by 20% in year 1. On the right, interest charges accumulate over a 5-year loan. By combining depreciation with interest, you trade future labor for an asset guaranteed to lose value daily. The anti-system pivot is to focus entirely on acquiring equity. This involves avoiding debt for any item that doesn't have the potential to appreciate in value. When you stop taking on debt for depreciating assets, you keep the full value of your paycheck, rather than sending a portion of it to a lender every month. Other traditional rules, like climbing the corporate ladder or avoiding financial risk, follow this same pattern. These behaviors prioritize the stability of a company's balance sheet over the growth of your own personal net worth. This creates a cycle where the value of your labor is consistently transferred away from you, a structure we call the generational poverty trap. This flowchart shows how it works in aggregate. Wages, savings, and car loans flow from the working class base into a concentrated point at the top. These myths ensure capital moves from those providing labor to those owning assets. There is a fundamental difference in how these two groups build their financial lives. One group is taught to work for and store currency. The other is taught to work for and control assets. Your parents gave advice based on a high-interest, low-inflation era where saving cash actually resulted in growth. In the 1980s, that playbook worked. But today, applying a strategy designed for 1985 to a high-inflation environment results in a steady decline of your net worth every year. By replacing these outdated myths with modern anti-system rules, you stop the transfer of your wealth and begin building a